All right, let's dive right in. Today, we're going to do something really cool. We're taking a world-famous investment checklist and applying it step by step to the insurance giant Progressive. We're going to let the numbers do the talking and see what story they tell.
So let's start with this question. How would the most successful investor on the planet actually analyze a company? What would he be looking for? Well, today we're going to use his timeless principles as our guide.
Here's the plan. We'll start with the Buffett checklist itself. Then we'll dig into the business, check its performance, look at its financial health, and ask the big question, is the price right? And then we'll get to the final verdict.
Okay, first things first, the framework. This isn't about some complicated black box algorithm. It's really about a disciplined, almost common sense approach to figuring out if a business is worth your money. And here they are, the 4 key pillars. It's pretty straightforward, right? First, can you actually understand the business? Second, does it have a track record of great performance? Third, is it financially solid? And finally, the most important one, is it selling for a good price? So let's put Progressive to the test.
So first up on the checklist, is this a business we can understand? And more than that, is Progressive a big company that's truly built to last? Let's see what the data says.
Well, the first clue is its sheer size, a market cap of over $118 billion. Right away, you know Progressive is not some flash in the pan. This is a huge, well-established company.
And look at this. This number really hammers home just how big their operation is. We're talking nearly $90 billion in revenue in just the last year. That's an incredible amount of business flowing through the company.
But here, this is where you see the built-to-last part in action. Just look at that 15-year return, over 1,400%. This proves it's not just a recent hot streak. This is a company with a long history of success. So for our first checkpoint, yeah, the numbers are pointing to a big, durable business. Check.
All right, let's move on to our next checkpoint. A long history is great, but how is the company being managed right now? This is where we really have to check on its performance.
And one of the best ways to measure this is a little something called return on equity, or ROE. Basically, it tells us how good the management is at using the money investors give them to actually make more money. It's a key measure of profitability.
And would you look at that? Progressive's current ROE is over 36%. Now, just for some context, a lot of savvy investors look for something around 15%. So 36 is, well, it's a fantastic number. But here's where it gets even better. It's not just a strong number on its own. It's actually getting stronger. It's way higher than its own 3-year average. What does that tell you? It tells you that management is getting even more efficient at generating profits. That is a huge green flag. So that's another big check on our list.
Okay, so we've got a durable business. It's performing really well. But is it built on a solid foundation of rock or a foundation of sand? This brings us to financial health. We have to look at the risk.
And the key metric for this is the debt-to-equity ratio. It's just a simple comparison. How much debt does the company have compared to its net worth? The lower this number is, the safer the business tends to be.
And Progressive's ratio is just 0.26. That means for every dollar of value the company has, it only owes 26 cents. That is an incredibly low level of debt. It points to a company that's on very solid ground. So, yep, another check mark.
Now this brings us to the final, and you could say the most important question of all. We've established that it seems to be a great company, but is it a great investment at today's price?
So a quick way to get a feel for this is the price-to-earnings ratio. Right now, Progressive's PE is just over 10. Now look at this. Its average over the last 3 years was more than double that at over 24. This is a pretty strong hint that, relative to its own recent history, the stock might just be on sale.
And this leads us to one of Buffett's most powerful concepts, the margin of safety. It's a simple idea, really. It's just the gap between what you think a business is actually worth and the price you have to pay for it on the stock market. The bigger that gap, the more protection you have if you're wrong.
So what does the math show us here? Well, according to this analysis, the margin of safety is a massive 75%. Now that is a huge buffer. It suggests the current market price is way below what its calculated fair value might be.
Okay, let's step back and look at the whole picture. We've run Progressive to this simple yet incredibly powerful 4-step checklist. What did we find?
So, what's the final verdict from the numbers? First, a large, durable business? Check. Second, strong and actually improving performance? Check. Third, rock-solid financial health? Check. And fourth, a potentially great price with a huge margin of safety?
It looks like a check there too.
So, based purely on this Buffett-style checklist, the data tells a really consistent, really compelling story. The company seems to pass all 4 tests with flying colors. But the real question we'll leave you with is this. Is this simple numbers-first story compelling enough for you and your investment philosophy? We've shown you the analysis, but the decision, as it always should be, is all yours.